Very happy to welcome for another VanEck Fireside Chat, Imaru Casanova, Portfolio Manager for Gold and Precious Metals at VanEck. Very fitting because VanEck has a history in gold, the first to set up a publicly traded mutual fund in 1968. Imaru, great to see you. Welcome Forward Guidance.
Thank you, Jack. Thank you for having me.
It's a good time. Gold prices are going up. As I'm sure you've noticed, over the past year, they're up around 30%. To what do you attribute this new bull market in gold?
The setup has been right for gold for a while, in my view. Um, as gold is viewed as a safe haven, no doubt the recent geopolitical tensions around the globe have no doubt been supportive of gold. Gold has also been strongly supported by central bank buying. And that, again, we think has been the strong central bank buying began in 2022, really in the second part of 2022, after the invasion of Ukraine by Russia. And we think Russia's experience with their reserves informed other central banks, and no doubt that has translated into increased central bank buying in the last couple of years, record levels of net buying by central banks. And that's really, along with the Asian consumer, very strong buying physical gold and jewelry from the Asian markets, has been the primary driver of gold prices in the last couple of years and this year. What has been missing from that equation is honestly the historical driver of gold prices, which is investment demand out of the West. So gold looks supported from here from central bank buying, from continued strength from Asian buyers. The outlook is very positive in that we haven't yet seen the Western investor come back. So a reemergence of that demand could be very positive for gold from here.
How much do you attribute gold's price movement to the movement in interest rates? General traditional view that rising interest rates, particularly rising real interest rates, are negative for gold, and that a fall in real interest rates are positive for gold. Interestingly, the rise in real interest rates from 2022 and 2024, gold did not go down as much as people thought based on that model. And now the real interest rates are looking to go down. And in September, the Federal Reserve is set to begin cutting interest rates. How does that shape your outlook?
Yes, no, it's a great question. And one we get asked often because you're right. The idea is lower real rates are gold positive for the obvious reasons. Gold doesn't pay an interest. So the opportunity cost of holding gold increases when interest rates are higher. The question is always what's happening? Interest rates have actually, the Fed embarked in a tightening program, and actually halfway through that cycle, gold sort of took off. And it's interesting because we highlighted that at the beginning of the tightening cycle, we said, look at previous tightening cycles. And what happens is, like it does for a lot of markets reflect not what's happening, today or the next few weeks. It reflects medium term and longer term expectations. So as the Fed embarked in its tightening cycle, yes, gold was pressured. As they got closer and closer to a pause, gold reacted in anticipation of that cut, in anticipation of that pause, and the expectations that as rates come down, gold would benefit. And so you're right, as the Fed, actually, as we speak, the Fed prepares we have Jackson Hole and news around that, what the path is, but the expectation is very much that the Fed will cut rates in September, that we view as gold positive. And it has been a driver. When I think of the drivers of gold prices this year and the drivers that I think will continue to support gold going forward, I have heightened geopolitical risk and global tensions, which support gold, the Fed path, and the expectation that they will start to ease as a supportive. I also include the risk that inflation might not continue to go down to that 2% target. Gold does well in environments of higher inflation. the risk that as the Fed eases, we could have a second wave of inflation. I think that is supportive of gold here. Again, central banks, which, to be frank, they have eased off a bit the buying in recent months. I continue to lend support, and we expect central banks to continue to be strong net buyers of gold. And then ultimately, what I think will be the catalyst, like I mentioned before, the reemergence of the Western investor. And I think that's key. And to answer your question, central banks behind this rally, do central banks really looking at, what interest rates are doing to decide if they're going to buy gold or not? Not really. They don't have that sensitivity. Western investors, they're busy investing in, the Magnificent Seven and everything else that it's yielding really nice returns and dividends versus gold. But as the environment changes, as far as Fed policy and the broader equity market, we think investors will have a reason to want to put gold in their portfolios.
Thank you. And yeah, for our audience, so inflation is falling, and inflation expectations are falling, but less than inflation. And nominal interest rates are falling by more than inflation expectations. So that's why real interest rates are going down. So Imaru, we could talk about just the price of gold, its drivers, its investment use case for a long time. But what I really want to know is how to invest in gold stocks. So primarily gold mining companies, but also gold royalty companies, which is a slightly different business model, because they have a different investment return and profile than gold. First of all, how did you get into investing in gold mining stocks?
So I'm actually an engineer by education. I went to Case Western Reserve University and got a bachelor's and master's degree in mechanical engineering. I built this super duper test rig that was trying to test failures in rotating machinery so that with our tools, we could predict that failure and avoid it. So we were funded by power generating companies. A lot of fun, very interesting, very hard. And then I'm Venezuelan. Originally, I was born in Venezuela. I came to the States when I was 16 to go to college, became a mechanical engineer, did go back to Venezuela, and actually, probably not surprisingly, for those who know a little bit about Venezuela, I went into the oil industry. I worked for Shell for a couple of years, and then things, as probably most audience also knows, things started to go sort of south in Venezuela, unfortunately. And I decided to move back to the States. And when I did that, I relocated to New York. And sort of like I did when I went to Venezuela, what's a good job market in Venezuela? What do you do to have a lot of opportunities? It was to go into the oil industry. When I moved to New York, it was in going to the financial industry. And after a lot of searching, how can I leverage my expertise? The answer was, well, you can leverage your expertise using your technical experience to do equity research. And that's precisely what I did. I did start with the oil exploration and production coverage. And then an opportunity came up to do gold mining. So my career started in the sell side, covering gold mining stocks. And eventually, after a few years in the sell side, led me to join VanEck and the active investment team, doing the same work, always focused in precious metal mining companies, gold and silver. And it's been about 20 years now, but that's how I ended up from being an engineer to being a portfolio manager.
Wow, that's an incredible journey. And I'm glad you said that. So you are involved on the active investment side. Perhaps the two ETFs that people might think of with the VanEck gold ETFs, those are passive funds. So important for us to make that distinction. How do you value a gold company? When you're looking at gold company A versus gold company B, what are you looking for that's attractive? And how do you say this one's cheap or this one's expensive?
Our in-house process relies on in-house models. Step one of our process is a quantitative step, your typical financial and operating model that we maintain in-house with very carefully chosen assumptions for a bunch of parameters. So our valuation model includes mine by mine detail of this company. So if you're a company with 10, 12 assets, whatever the numbers say, Newmont, the largest gold mining company in the world, we model each of their mines in each of their region. We model how much production is going to come out of each of those mines annually. So we get the ounces, which is your revenue side. And then we also estimate for how long they're going to be able to produce from that mine. And that's based on our assumption of how much gold is in the ground at each of these mines. And, obviously the companies report this figure. So you go to your company statesman and they'll have a reserve and resource statement where they'll say X mine has, 3 million ounces of gold. If we're producing 300,000 ounces a year, then we're going to probably model that mine will produce for 10 years. Obviously, it's the variations year to year and so forth. There are our in-house models, and why it is key is because, we know these companies. The companies can only prove up a certain number of reserves, right? It takes drilling. You can't say the gold is there until you drill it at a certain density to assess that, okay, I have enough holes to pretty much know, like in the places where I don't have holes, I can interpolate what sort of deposit I have. Obviously, it is expensive to create that level of drill density that you need to say this is at reserve level state ounces. Then you get your ounces that are not drilled as densely as the reserve. Those are called resources. And there's basically more uncertainty around those figures. But we as experts, from the type of deposits, from the geology of the deposit, and just the fact that we've, modeled a lot of these mines before, we can make an assumption that, listen, we're pretty sure that some of these resources are going to become reserves and they will be mined. So even though our mine has 10 years of life as reserves, we might model 10 more years. And that's where our expertise comes in. And it's important for investors to understand that. Because if you look at a company and you value it just in reserves, that company might be looking quite expensive, when in fact, we know that a lot of what our resources will be transformed into reserves and they will be mined. So that's part of the first equation. How much production for how long? That's your revenue side of your model. And then we need to worry about the other side, what are the costs that are going to offset those revenues. So obviously production and gold price, two critical inputs. And obviously, and for our models, we use spot. We do everything as spot. Everything is linked to Bloomberg. We pull our data. We get real-time currency and commodity prices, gold, silver, copper, whatever commodities we have in there. And we're pricing daily our models at spot. So that's your revenue side. Obviously, the higher the gold price, the higher the revenue. And then, of course, we can't forget about the other side, the cost side. And so we model cash costs, which in the industry should be those costs directly related to extracting the gold from the ground. These are your mining costs, and then your processing costs. So it takes a lot of work. It's a lot of rock that needs to be moved. So there is usually costs are mining cost per ton of rock moved, and then you get cost per ton processed, and that's your metallurgical side. So you get your rock out of the ground, you put it through a processing, and then at the other end, you get some sort of concentrate or doré. How much does it cost to do that? That's one part of the cost equation. And then another important part of the cost equation is the cost that it takes to maintain the mine. And those are referred to as sustaining costs. So they're not necessarily related to the extracting and the processing, but you need to maintain your underground development in shape. You need to do things you need to continue to develop your underground mine and open up strip material out of an open pit. Those are not necessarily operating costs, but they're sustaining costs. They are operating costs. They're not cash costs related to the processing and extraction. And so you take all that in, and we refer to this in the sector as all-in sustaining costs. It doesn't include capital you are putting into the mine to, expand your reserves or an expansion of the plan. Those are what we refer to as, other capital costs that are not sustaining. This is the cost that it takes to take the to maintain the existing operation at current levels of production. All-in sustaining cost is what offsets your revenue. And based on that, for each mine in our models, we come up with how much cash flow these mines are going to generate. Of course, then we have our balance sheet, how much debt does the company have, how much that's going to cost in interest. Obviously, if you're interested in earnings estimates, our depreciation calculations, so that we can arrive at earnings estimates, which I'll point out I am not obsessed with in this industry. I'm very much focused on cash flow, long-term cash flows. These mines are producing for 20, maybe more years. So we're looking at the whole horizon. And ultimately, our models, our in-house models, after we plug all these numbers in, what we're after is how much free cash flow these companies are generating per ounce of reserve or resources per produced ounce. That's what we're after. And we're going to compare that free cash flow per ounce over the 20-year horizon of these companies that we model against each other. If you produce more cash per ounce, then your ounce is a better ounce. And we like it more. It means you are generating more value. We compare the companies on a relative basis and assess, to your question, who looks expensive and who looks cheap based on just valuation. So that's step one. I'll stop there in case you have questions on that.
Thank you. Okay, so you like to value it on cash flow over net earnings or net income. We can get into why as well as the differences between that, but I just want to talk on the valuation now. According to an article you wrote recently, well, actually the data was as of June 30th. In Q2, the all-in sustaining cost for all miners, or I don't know, in some index, was a little over $1,400, and the gold price then was a little under $2,400, implying a margin of $910. And now, assuming the all-in sustaining cost is the same, which it may be very slightly higher in 1 quarter later, but the gold price is over $2,500. So are your models suggesting that for the average gold company or whatever index of mines that you did this previous analysis on, is the implied margin of the gold price minus all-in sustaining cost over $1,000 right now?
That's it. You got it. That's why we put those charts there, so that people can do the math. Because to be clear, one of the reasons I think investors might have questions about the sector is that in the past, as the gold price increased, so did cost. So that margin expansion, that is the reason why you own gold stocks. Gold stocks have leverage to the gold price because of that margin expansion, because they have a cost side. If the costs keep increasing, sort of offsetting the increase in the gold price, then we're going nowhere. So I put that chart there to show that, yes, we did have a wave of inflation in 22, like the whole world did. The miners were impacted too, and costs did go up significantly in 22, a bit more in 23. For 24 and forward, we actually see costs contain around that $1,400 level. And to answer your question, that's the universe of companies, average cost, all-in sustaining cost for a universe of companies of one of the brokers, Scotia, I think. And so that's for their universe. That's the average all-in sustaining cost. And in that note, we were highlighting the increase from Q1, which was a price of about $2,100, to Q2 at around 24. Big jump in margin from about 600 to 900. And now you're pointing out the same, even at a higher jump, because we're $100 higher today with gold at 2,500, and costs should be just around that 1,400 level still. So yeah, these companies are going to generate a lot more free cash flow if this $2,500 gold price sustains. And that is key to obviously our valuation.
And relative to the increase in gold prices over the past 1 to 2 years, how much is your average gold mining stock up? Rough numbers or the index, and then does that compare to your expectations? Do you think that the gold mining stocks are fully pricing in a $2,500 gold price?
Great question. I know. So the reason we are so constructive on the gold equities is in large because they have lagged so much the gold price. One of the brokers, Scotia as well, we like a lot of their work. They do this valuation of gold versus the equities, where they say what is the price that the gold equities are discounting. And surprisingly, it's about a 20% discount to the current spot price. So gold equities, it's not a secret, have been lagging the metal for quite some time. Q2 was a quarter where we finally saw the equities show that strong leverage to the gold price, with the gold equities outperforming the metal. But over the past several years, that hasn't been the case. So no, I do not think the equities are fairly valued at present. They still need to reflect that $2,500 gold price. And if you look, it's easy to see it, in my view. If obviously gold's been making new highs basically every month this year. And yet when you look at the gold GDX, for example, the levels that the GDX is at today are the same level that the GDX was when gold was $1,800, $1,900 gold. So we do think there is quite a bit of opportunity here for the equities to catch up and reflect that higher gold price. And I like to emphasize that the reasons we're so positive on the outlook of the gold equities here is not just based on gold price, although clearly that is the largest factor. We're also very constructive because of how these companies are running their business, because costs are contained, because companies are being very disciplined on how they invest capital, because they're returning dividends to investors, they're buying back shares. They're doing a really good job managing risk when it comes to investing capital and expanding production. And so balance sheets are in good shape. Debt levels, some companies have cash in excess of debt, some have no debt. Those that have debt have manageable debt levels. So everything fundamentally is looking very good for the gold stocks. And then, of course, the gold price continues to rise. So to us, a perfect setup for the equities.
Right. And that GDX, you mentioned it's a VanEck ETF. That is a passive fund that you are not directly involved with. You are on the active side.
Correct.
To remind people again. And so what is an example of a company where you think it is fantastically managed and they are allocating capital in an efficient way? In other words, they're not just spending millions of dollars in the hope of maybe getting a mine in 10 years, but they are very profitable and being very conservative with their cash.
If I can mention a specific gold stock, then I have to bring up Alamos Gold. I think Alamos is the perfect example of a company that we consider very well run, where we actually have some growth coming from the expansion of one of their mines, where capital allocation has been fantastic. Most recently, and that's highlighted in my monthly notes, in one of my recent monthly notes as well, Alamos acquired Argonaut, which happened to own an asset that is adjacent to the asset that Alamos is delivering a lot of their growth from. So Island Gold in Canada is right next to the Machino gold mine that Argonaut owned. And now this is going to be one consolidated large asset with, of course, tons of synergy. Machino is already in production. Some of the things that they needed to do at Island to increase production, they won't need to do anymore because they can use Machino infrastructure. The synergies are endless, very natural, very easy. Alamos bought Argonaut when, the Argonaut stock was very cheap, took advantage of that and I'm sure will deliver amazing value creation for shareholders. They have assets in Canada, so their jurisdiction profile also is very attractive. They have some exposure in Mexico. Mexico it's not Canada, but it is has been historically a prime mining jurisdiction with some challenges recently. But that asset that, if you would have looked at our models for Mulatos, their mine in Mexico, we would have been cutting off that mine already. If you looked at our models a few years ago, we would assume end of mine at Mulatos, coming up soon. they keep finding satellite deposits and other deposits that continue to extend the life of mine in that mine, again, delivering further growth and value creation for shareholders. So that it's to me a perfect example of and I will mention, which to us is critical, and I tell the CEOs of the companies we run, I tell our investors, I tell the whole world, Alamos, that's something that is critical for the sector. They meet their targets. They put out guidance and they do what they said they were going to do, which the market rewards them for.
Got it. Thank you. Earlier, you said someone's in Mexico and Mexico is not Canada. What did you mean? And can you speak to the broader, how much you pay to jurisdictions, where the mines are?
It is a very significant factor for valuations of gold miners. Canada is certainly not Mexico, and honestly, disappointingly so. If you would have looked at the world, a decade ago, a little less maybe than a decade ago, Mexico, Canada, Australia, the US would have all been sort of in that same number. Mexico maybe still a bit of a discount to those other jurisdictions, very, very much on par. Things have changed in Mexico, with the most recent administration, and that has had some negative impacts for the gold mining industry, the risks around mining in Mexico. There have been some proposals by the about to be outgoing administration to potentially ban open pit mining, which obviously would have really bad ramifications. New mining permits have been basically non-existent. And so those that are operating are doing okay. There is security risks in Mexico. There's a lot of factors that make today Mexico a lot less attractive than it used to be. Just to give you an example, before 2008, our active strategy would have been, we do our numbers on a weighted basis based on the reserves that each of these companies have in each jurisdiction, and based on our position size. We weight average this exposure, and before 2008, before the end of 2008, we would have been 13-14% Mexico. I don't know what the number is today, but it might be closer to 5. So we've significantly reduced our exposure to Mexico because of this. And to answer your second part of your question, that's on Mexico, and there is a new administration coming. We're, cautiously optimistic that maybe that can lead to enhancing the attractiveness of Mexico for gold mining. But to answer the second part of your question, yes, jurisdiction has a big impact. So when I say Canada is not Mexico, Canada has processes, rule of law, agreements, things that allow you to operate within, yes, it takes time to permit mines in the US and Canada, but once you have your permit, you have security, it's, business as usual. And so investors do pay a premium for assets that are in more stable jurisdictions. And that plays a significant factor in our valuation. We don't quite try to build country risk into our financial and operating model. I think that can get really tricky, but qualitatively it enters our assessment. And so when I say we look at relative valuations based on our models, somebody that plots cheap, then you see that their assets are in Burkina Faso versus let's say the exact same company as far as quality, asset, cost, but they're in Canada or in Australia. Clearly, one is going to trade at a discount relative to the other based on the risk profile affected by where these mines are located. So a very important consideration. And, we can think of many examples where being in the wrong jurisdiction has, impacts share price performance.
How do you deal with the fact that a lot of the companies that are in the riskiest jurisdictions happen to have the lowest cost mine? Because you would want the lowest cost mine with the best jurisdictional risk or the lowest jurisdictional risk, but you kind of have to choose one or the other. So when you're presented with that choice, as I imagine you often are, well, how do you think about it, and what process do you use to make the decision?
It's very tricky. It's probably, when it comes to I like to think a lot of it as risk management. A lot of our job in picking stocks in this sector is risk management because honestly, there are a lot of risks for this industry. Whereas jurisdiction risk from a government or a community demanding or it's changing terms to geological uncertainty, metallurgical uncertainty. There is a lot at play. We had a company report results today that had to downgrade guidance because there was too much rain in some of their operations that impacted their production for the year. So, these things happen, and so there is a lot of variability quarter to quarter, and that a lot of risks to manage. So for us, the managing this risk, you're right. Wouldn't it be wonderful if all the best minds were also in the best jurisdictions? But very rarely they are. And so we looked headline risk and as an area, a region that could be considered by the broader market as very risky because of what's happening at a political level, at a social level. We find some regions where this is all true, and then it puts that valuation discount, but that we know these companies that are operating gold mines do so successfully and without trouble. And so they're generating free cash. They're operating in within this environment more broadly for the region that isn't perceived as, positive. But we have the expertise to know that they can actually get the production out of the ground and operate. And so we have to be very careful not to confuse, mining out the outlook for miners versus the outlook for, the country or the community or the currency. And so we do make those distinctions, aware that despite our assessment and the fact that these companies will produce and will be profitable and would do it in a stable manner, their stock price still going to be under pressure. So it's a balancing act, and it comes in waves sometimes, depending on what's happening in the country. But we will not invest in areas where clearly, there is risk that your mine is going to be expropriated by the government. We won't go to those areas. And the quality of the deposit, it still plays, a big role. We won't invest in mines that are in Canada and Australia and have a great jurisdiction profile when we think their mines are are not high quality, costs are too high, or there are other risks to the operation. So both factors play a role, but I think at the end of the day, grade is king. The higher the grade of your deposit, the lower your cost, the better mine you have.
Let's go back to you said you prefer the metric of cash flow and free cash flow over net income. Tell us more about that.
I'm just, you want to know just what these companies are worth to me. They're worth the level of free cash flow they produce. I don't really care how you do the math. I just want to arrive at how much money are you making for me on analysis. How earnings are subject to quarter to quarter variations on how they decided to account for stripping. They have to move all this rock. Part of it goes into the expense side, the other goes into the capital side, so it gets depreciated over time. To me, that just pollutes my thesis. I want to go to the bottom line. Forget all these cash or non-cash activity that gets put in your income statement. Just show me the money. Free cash flow. What is that this quarter? And also, that's the reason why I'm not obsessed with net income and earnings, but I just want to get to the bottom line. Also, I hate the variability quarter to quarter. And I know the markets are very focused on what's the earnings for this quarter. Did they meet estimates? It's so hard to estimate because so many little things can change that are going to throw off your earnings estimates, and honestly have zero impact on the valuation of these companies. If you tell me they depreciated a little bit more this year, so the earnings were higher, I don't care. I want to know how much they produce and at what cost. And so the variability quarter to quarter, it's also very distracting to me, because I'm looking at this company we're long-term value investors. I'm looking at this company, like I said, for the next 20 years. And so what they, whether they produce 100,000 ounces this quarter and they miss 20, but they'll produce 140 next quarter, it works for me. Just, as long as you're producing those ounces at some point and understanding that there is so much they have to manage. Like I say, you drill a hole and you make estimates. When you get down to the mine, you might find that the grade in that part of the deposit that you're mining this quarter, it's a little bit lower than your model suggested. Well, not really shocking, right? You don't have data for every point in the mine. So there is bound to be variability. And as long as over the longer term, over a 5-10 year period, they are demonstrating that their model, their average grades, their average costs are within the model that they deliver to the market, then the value proposition remains the same. And so I am not focused on earnings, and I'm also not focused on quarter to quarter, but longer term deliverables.
Right. And I just want to say, sometimes people go on TV and they say, we're not interested in earnings, we're interested in this other thing that's non-fundamental. When you say cash flow, that is a fundamental basis. So you're doing very, very fundamental work. It's just you prioritize a different model.
Yeah.
Tell us about, so I think a few of the key differences between net income and cash flow is cash flow doesn't include depreciation, and it doesn't include CapEx. CapEx being a minus for free cash flow and a positive for depreciation. So I guess a key difference between free cash flow and net income is that it's basically depreciation minus CapEx. Can you tell us just about that difference and how you think about the importance of depreciation and capital expenditures and how that impacts the value of the mine?
Yeah. So, I'm looking at my model here, and obviously there is the depreciation has cash flow ramifications, because at the end of the day, the companies net the depreciation expense against their cash flow, their pre-tax, cash flow, and they're going to pay taxes on that figure that excludes depreciation. So the higher your depreciation, which is a non-cash effect, the less taxes you're going to pay. So it does impact, that quarter to quarter cash flow on the basis of taxes, although obviously it gets tricky because some taxes are deferred, etc. But let's ignore that. So how do we calculate? So we in our models, we do try to, do our best to estimate that depreciation expense so that we can take into account the impact that it has on taxes paid. And the way the industry-wide, really, the companies and the analysts, it's pretty straightforward. You know how much capital has been spent at these assets, and it gets, accumulated. So as you develop these assets, not all of that capital gets expensed. Some of it gets put into the capital section and eventually needs to be depreciated. And the way it is depreciated is you take the accumulated capital expenses, and every year you look at how much you have produced, and you expense the depreciation that by the units that you produce. So it's units of production. So, you say you build a mine and you spend $1 million building it, which is obviously not the case generally, but to keep numbers easy, because I can't do a lot of numbers in my head anymore. I need my spreadsheets. So you spend $1 million and you're going to produce 1 million ounces. So you capitalize that whole $1 million. Every time you produce an ounce, you depreciate $1 per ounce. And so if you produce 100,000 ounces this year, you would depreciate $100,000 of your 1 million units of production. So you take your capital spent, and then in the numerator, your denominator is all of the ounces that you're going to produce, or at least your estimate of the ounces that you're going to produce. Usually it's your model, right? The deposit has 3 million ounces, and every time you produce an ounce, you depreciate that corresponding figure. And, that will have, like I said, an impact on your earnings, clearly. So it's pretty Exactly what ounces are in the denominator may vary from analyst to analyst and so forth, but overall, that's the method employed in the industry for calculating depreciation. Since you asked.
Yes. And what are some things that people who, like me, who are not a veteran of conducting financial analysis via spreadsheets and valuing gold companies, what are the most common mistakes that gold mining stock investor newbies or even intermediaries make?
Let's say a common mistake could be, let's say a company is producing out of an asset, and in this year, next year, in 25, they are going to produce at a much higher grade. So let's say your model says your grade, and to be clear, grade is grams per ton or ounces per ton, is how much gold is concentrated in a ton of rock. And that just goes to point that there's very little gold, right? Gold is very scarce. So you have to move and process a lot of rock to extract a gram. A high grade, grades could be up to 20 grams per ton, but like a lot of the mines that are in production are, 4 or 5 grams if they're high grade, or they can be, less than a gram per ton. Anyways, that's great for those that. So that's a very important parameter. And what happens is your model could say, oh, the average grade, obviously it varies, right? Some rock is a little bit higher, some of the rock is a little bit lower, but you average it all out. And this deposit that has 1,000,000 ounces in there, it's, 5 grams per ton. But in 2025, these guys are mining a zone, a high grade zone that is 10 grams per ton. Also, guess what? Because you're moving a lot less rock to produce this higher content of gold, your costs are going to be a lot lower that year. Because obviously, more gold for the same amount, or a lot of the expense is moving rock and processing rock. So if you're moving and processing less rock to obtain more gold, your costs per unit are coming down. And so then if you're an investor that is about to make a mistake, you go, oh, costs are, for, $900, $1,000 per ounce. Perfect. Let me make that assumption for the other 10 years that this company is producing. But wait, because that grade, eventually, if the model is right, that grade is going to come down in the next few years so that, the average is the lower average that they initially said. And when that grade comes down, their cost per unit are going to go up. So investors have to be, if you're getting to that level of modeling a company, pay attention to the grade versus reserve grade. Because that if it's higher one year, that grade is going to have to come down in future years. The opposite is true. If they're mining lower grade, the costs are going to be higher, which means it would be unfair to assume that the costs are going to be that high for the entire life of the mine, because the grade should come up and costs should come down. So that's one that we have to watch out for all the time in our models.
That's very interesting. So I understand if the grade is high and you continue to mine, the grade will go down. So less gold per square foot or however you measure it. But why, if you start with a low grade, why you say it goes up? Because you hit a part of the mine that happens to be lower grade?
Yeah, so let me explain. So let's say you have this box. You drilled a hole here and a hole there and a hole here. And the grade is, it's not a homogeneous box. The deposit, it's 10 grams here, 4 grams here, 6 grams here. And you say, okay, on average, it's 5. If you're in the high grade zone today, at some point you're going to have to go to the low grade zone. And when you do, because you're moving more rock to extract less gold, your costs will go up. So that is why and the reason we know this number is because the companies publish this number. When they put out a mine plan, they tell you, here's what we got. We got a deposit with this average grade. And so always compare current grade to average grade of the deposit and the impact that it has in costs.
Wow. Okay. So if the current grade is lower than the average grade, it could get better. So maybe just keep that in mind. And if the current grade is higher than the average grade, it could get worse. That is something, Ima, that I don't think a lot of people investing in gold stocks know. So I'm really glad you said that.
And it's critical. It's critical.
Yes. Thank you for that. Tell us about gold royalty companies. Do you like them? And what are they?
Royalty and streaming companies, and we're getting out these days a lot more streams than actual royalties. But these sectors known as the royalty and the companies and streamers, sometimes companies refer to them as streamers, are companies that do not themselves own and operate mines. They're a bit more like us, a mutual fund manager. They own portions of the mines of other portions of the production of the operator's mines. So let's say, you got Barrick, Newmont, Agnico Eagle, Jack, your royalty or streaming company, which would be really nice for you. And
Yes.
me.
You can invest.
I'm Barrick, and you tell me, I'm gonna tell you, Jack, I need to, or any other producer, large mid tiers, they finance the entire spectrum. So I'm about to build a new mine, and clearly I need capital. And you are a royalty or streamer, and you say, well, Ima, if you need capital, provide some of that capital for you in exchange for a portion of the production of that mine. And let's say I'm a copper producer, but I have a gold, comes with some gold or some silver, or the opposite. I'm a gold producer and comes to whatever the mix. I'll say, you know what, you can take my gold, and that's, whatever. You can take 100% of my gold. Or if I'm a gold producer, I could say, you can take 20% of my gold. Give me the capital to pay for that. And you get that gold no matter what. So these streamers do that with tons of assets. I mean, the larger the company, the more assets, but it can be 10, 20, 30 producing assets, and they invest early. So they have also assets that are in development and assets that are early stage. But the idea is that they own that production. So once that mine goes in production, you come to me and I tell you, okay, Jack, the mine is now in production, and you don't really care at what cost I'm doing that. All that emphasis I put before on cost, because that's what impacts your profitability. The royalty and streamers are fairly, shield and protected from cost, because all they get is 20%. You don't care what cost I'm doing it. You don't care. The mine has to be in production, to be clear. So it's not like these streamers and royalty companies are risk-free. If the mine stops producing, which sometimes they do, you're not going to get your stream. So, but as long as the mine is operating, you get your 20%. You get if it's a stream, you get your 2, 3, 5%. If it's a royalty, and happy you go. You got your gold or your cash, whatever you're delivered. And whether the costs were to 1900 or whatever the figure might be, it's really not impacting you. And so that is the attractiveness of the royalty and streaming model. It's, to me, one, that they're very diversified. So if you're a 2, 3, 4 mine producer, what happens in every mine has a pretty large, obviously, effect. If you own 20, 30 streams or royalties, there's a lot more diversification. 2, you don't have the cost side to worry about for the most part, unless obviously cost gets so high that the mine is going to shut down, then that's not good for you. So streamers and royalty companies are getting pretty smart about structuring their deals so that they don't put too much pressure in the cost structure, so that this mine obviously can successfully operate. And so diversification and not having that cost exposures is what makes this model so attractive. And then on the flip side, it means they're not as leveraged to the gold price. So as the gold price increases, yes, their earnings increase, but not quite as much as they do for the producers, which have cost exposure. But it's a brilliant business model in our view, and for the reasons I outlined. And so we maintain exposure to that sector in our active strategy.
I see your active strategy is invested in Osisko Gold Royalties and Wheaton Precious Metals, which are also precious metals streaming companies. But I also notice a smaller percentage is in a very large streamer, Franco-Nevada. So tell us, why are you overweight Osisko and why are you underweight Franco-Nevada?
Yeah, we like all of the streaming companies. I think, at least in my view, are well-run businesses. So it's the big four, right? Royal Gold, Franco-Nevada, Osisko Gold Royalties, and Wheaton Precious Metals. We own all four. We are a little underweight Franco. It probably won't surprise. We were able, I think Franco was one of our largest holdings a couple of years ago. And, they did face pressures after really a chunky asset for them. We talked about diversification, but the Cobre Panama mine in Panama, operated by First Quantum, represented approximately about 20% of Franco-Nevada's revenues and valuation. So pretty large exposure to a single asset. And you may or may not have heard, or your audience, that mine was shut down by the Panamanian government. And so as we anticipated, it wasn't shut down on day one. The news came out that there was the risk that the mine was going to be shut down. We reduced our exposure to Franco, given the risks that the mine would be shut down. It made absolutely no sense for that mine to be shut down for the Panamanian people, but some things happen where things that make absolutely no sense still happen. And so markets for a bit were not convinced that the mine was going to shut down because it seemed so unreasonable. But we wanted to manage that risk and reduce our Franco exposure in anticipation. It is still a very good business. They have gone ahead and written down Cobre Panama entirely. So it is fair to assume that the market is basically deleted Cobre Panama from Franco value. And there is opportunity now that they get re-rated again after what was a pretty, obviously big hit to the stock. But that's why today we're underweight, but we're always reassessing the outlook of these companies. And next thing you know, we could be overweight Franco. We do like the business model and the company.
How often do you invest in very, very new projects? I believe they're called Greenfield, as opposed to Brownfield projects where, the shovels have already gone through the ground, as well as companies where their business model is to create a mine and then have it be bought by a bigger company.
Let's define some things here. So obviously large producers and miners and mid-tiers have Brownfield and Greenfield projects. So we are exposed all across to both Brownfields and Greenfields. I think what you're referring to is how often do we invest in those companies that are only now developing a Greenfield project.
Yes.
And those are usually referred to as developers. So in our space, we have our seniors, the large companies with a ton of mines, the mid-tiers, less market cap, less mines. And then we got this junior space, some of which includes junior producers. So you're already in production, but you might have a mine, maybe 2 small mines. And then you got down the spectrum, your developers. And those are you guys, like you said, who are just busy drilling. I talked a lot about drilling and why that's required. To define a gold deposit, you have to go and drill it so that you can show me that this deposit is in fact there. And so these guys are not generating revenues. They're just busy defining their project. And just to give you an idea, about 15% of our active portfolio right now is invested in those companies. So it's quite a differentiator for us. We have about 30% of the portfolio, little less, 20, maybe 27 of the portfolio today is in junior space. About more than half of that is in developer space. So it's been a sweet spot for VanEck. I think it's not coincidence that our team does have technical expertise. We have geologists and engineers in the team that allows us to look at those early stage opportunities, make an assessment. We get the drill data, we look at it. We don't wait for them to tell us, oh, we think there is X here in the ground. We trust their data. We can't go and produce the data ourselves, but we take their data, they'll drill holes. We understand how these deposits work. And we say, oh, this could actually be a good deposit. It looks like it could be mined economically. And we'll go ahead and make very early stage investments. Historically, we have been really good at making those early stage investments and benefiting from the re-rating and the share price appreciations that comes after these companies prove that yes, indeed, we have a deposit that can become a mine. There's a lot of deposits, right? They're not all going to be mines.
What would stop a deposit, a gold deposit, from not being mined? It's too expensive. It's unrealistic to, to get all the equipment out there.
Many things. I mean, very high level, it could be a country could stop you from developing a mine. A community could stop you. If you're going to do it in an area that is sensitive, that has fisheries, that have archaeological issues. And obviously, you try to get all that out of the way, but um, the permitting can be very long, and sometimes there are regions that just refuse to let you build a mine. So that could prevent you from building a mine. But we typically try to assess those risks early. Um, it could be, once you drill more, you find out that the gold that you thought was there is there, but the grade is so low that it's not worth, digging however many meters to get it out of the ground. It's too much work to get too little gold, so it is not economic. It could be that once you get some samples and you process them, you say, yeah, the gold is actually there, but to get it out, it is so trapped in a sulfide or in some other element that to extract it, we're going to have to do some very complex, metallurgical, oxidation, pressurization process that is too costly. And the recoveries are going to be, we're going to get, a certain amount of ounces out of the ground, and then we're going to only recover 40-50% of it unless we spend all this capital, which is not justified because we don't have size. So that's why size is so important, because you can pay for a lot of this processing and equipment and expensive technology that you might need to extract the gold. And you can do that, and you can build all this facility if you've got 4 or 5, 3 million ounces. If you just got, 500,000 ounces or a million, then it doesn't work. The economics don't work. So it's a bunch of different factors that can determine that, this mine is going to be in production or not. But more and more, it is regulation and environmental considerations and communities. Take Panama, take Guatemala, where there's one of the best silver deposits in the world, with a beautiful, fresh, minted, plant ready to go. That mine is shut down. It is not in production because, the government and the community haven't come to an agreement. So many different factors can prevent a gold deposit from becoming a mine.
So you're saying it needs to be economies of scale. It needs to have that 3 million ounces, 4 million ounces. Yeah, 1 million ounces sounds a lot
Whatever
to
the
me.
number is,
Yeah.
it doesn't have to be 3 or 4. If you're processing technology, if you're heap leaching, which is you take rock, you stack it, then you throw fluid on top, and the gold just leaches out. That's not nearly as expensive as building, a whole facility to process the gold. So you might be processing, 0.3, 0.4 grams per ton because this stuff is cheap. So it's a combination of factors. The economics have to work.
Well, Ima, thank you so much for joining us. Could you just give us a quick summary of your current view on gold mining stocks as we sit here with the price of gold above 2,500?
Like I said at the beginning, we are very constructive on the gold price. We do think there is room here for gold to continue to climb once we get investment demand out of the West to return. I look, for your audience, I look at the global gold bullion ETFs as a proxy to investment demand. If you look at where those levels are today, they're very well off their peaks.
In terms of
If we
AUM, in terms of
holdings, yes.
yeah.
So because those holdings have actually been in decline since April of 22. So if you get that, just that investment demand, which, obviously we could exceed that depending what environment we're in, but just getting back to those peak levels of global bullion ETF holdings could mean to gold another $300-400 per ounce from here. Just simple historical math, not making any forecasts or projections, but it's easy for me to arrive at that figure just based on previous demand for gold out of that sector, which, like I said, has been the historical driver of gold prices and has been absent in this rally. So that's a pretty historic shift in my view. Central banks being a main driver instead of investors. It's a historic shift. If we get both central banks and investors together, this could be the perfect storm for gold. Let's not forget that gold is very under-owned. Something like 1% of global financial assets is invested in the gold sector. So, just a little tweak, a little increase in that could have very important ramifications for both gold and gold stocks. When it comes to gold stocks, like I said, I'm positive on gold, even more positive on the stocks. And I'll just reiterate what I said before to close is yes, higher gold price means the stocks should show that leverage via margin expansion. And we're confident that the companies are doing the work to allow that margin expansion, and also that they are going to invest the free cash flow that they are generating from these higher gold prices in a value accretive way that will deliver, significant returns to shareholders. So we're very positive in the space. The companies do have to focus on meeting expectations. The market is sort of obsessed with, not just earnings and estimates, but production cost estimates. You put out at the beginning of the year, the companies issue a guidance. The market wants that guidance to be met to reassure markets that companies are being consistently delivering. And so I do think we need a few quarters, and we had a very positive second quarter. The second half is supposed to be even better operationally for a lot of these companies. So hopefully that translates into also good results for the last part of the year.
Thank you, Ima. A pleasure to hear your views, not just on gold, but investing in gold mining stocks and how the businesses are differ, why you prefer some and not others. Ima, I'm just preempting a comment in my head about someone said, you had this precious metals expert on and you didn't ask one question about silver. So I'm just going to ask you your thoughts on silver. And because silver and gold are found or similar next to each other, around 8% of your fund is in silver, over 80% is in gold, but you do have a little bit of silver exposure. So your thoughts on silver?
Yes, you're absolutely right. I honestly think of gold and silver as the one of the same. I will make there are some important differences, but silver has been lagging gold, playing a little bit of catch up this year, but after a few years of underperformance. So coming into this year, I was very bullish silver prices because of that underperformance, just as I'm bullish equities because of the underperformance against the metal. Silver has the potential to return to historical gold to silver ratios, right? Pay attention to that. Take the price of gold versus the price of silver, gold at top, silver in the denominator. Historically, that ratio has been closer to, 65, maybe it's closer to 70. Today, it's somewhere around 85. So if we were to return to historical levels, that means silver could be, set to outperform gold from here. So if gold does well, I expect silver to sort of ride along with gold. But silver has an additional component of demand that could, bode very well for silver relative to gold, which is an industrial component. So it is no secret that silver is using a lot of applications. More recently, though, the expected growth of solar power generation will translate to a lot of solar power panels having to be built. And guess what? There's silver and there's solar panels. So there will be, if those projections, are correct, then we are going to go to much higher levels of renewable energy, including solar. That could bode very well for silver demand. I think it's important to remember that silver demand is fairly inelastic. They're the same. We've gotten the same production out of silver production out of these mines for, at least a decade or two. So an increase in demand could have very positive implications for silver price. And so, yes, we like silver. What I would say when it comes to silver producers is it's a tiny universe. Let's be clear, the gold mining universe is pretty small, right? Like
Relative to
and
NVIDIA, yes.
to anything really. But yeah, I think I read this. I was like, oh my god! I read somewhere that Nvidia's market cap drop in a single day is the size of the gold market. Something like a call it 400 billion, right? Like small.
Of the
And then
gold
when you
mining
move,
stock market.
yes, the gold mining universe is, I don't think it gets to 500 billion. You can include a bunch of little companies there, still market cap is low. So the point being, it's small gold mining universe. When you go to the silver universe, I don't know, I have the figures, but it's even smaller. There's less companies. There's a lot fewer primary silver producers. Silver is often produced as a byproduct of other metals. So to find pure silver producers or stuff, even the companies that are silver in our holdings produce a bunch of gold or other metals. So, anyways, all that to say, we struggle to find a lot of opportunities in silver, even though we like silver very much because it's such a small universe.
Ima, thanks again for joining us, and thank you everyone for watching.
Thank you.
Hello, everyone. As always, thank you for watching. I do have some rather important news concerning myself and forward guidance. This will be one of my last forward guidance episodes. Very shortly, Felix Javin, the current host of the On the Margin podcast for Blockworks, will be taking over forward guidance. Felix is an extremely talented macro mind and trader, and I'm confident that I'm leaving the forward guidance audience in good hands. I'm very grateful to Blockworks for taking a bet on me, to VanEck for their continued faith in me, but most of all, to you, the audience, who with your passion and interest in my work has allowed me to do what I love for nearly 3 years. I'll be leaving Blockworks to host my own podcast, the working title of which is Monetary Matters. Stay tuned for more information about this. But in the meantime, you'll have a few more interviews from me talking about collateralized loan obligations, trust preferred collateralized debt obligations, balance sheet recessions, and much more. Until next time.